Today on the show, I have the pleasure of speaking with Vince Caviglia. Vince has worked in the real estate industry for over 15 years with direct experience in a range of areas from mortgage lending and debt syndication to acquisitions of commercial properties in varying different markets across the United States. And most recently, he has co-owned and operated a very successful residential fix and flip company here in Southern California, which has evolved into his company today, which is called Equity Group Investors. Now, over the last 8 years, Vince has established a consistent and solid track record for creating positive returns for his investors in San Diego, in the San Diego area, which is a very tough market to be doing business, particularly in real estate investing. And his steady methods of and generating profits and revenue have continued to attract and repeat investors into his real estate investment opportunities, which is really, really incredible for him and his business partners. G'day, Vince. Welcome to the show. How are you doing today, mate?
Thank you. I'm excited to be on here. I've been listening to your podcast. It's one of the best real estate podcasts I've heard. So I'm now a follower.
Wow. Yeah. That's a huge accolade. I thank you so much. Thank you so much, my friend.
Yeah.
Well, as an avid listener, I'm very privileged to have you on the show because you also have a wealth of experience. And we want to get into that. We're going to talk a little bit about today about how you're developing a fund. But as we do with every show, we start the show with rewind the clock and tell me how you made your first ever dollar as a kid.
This is funny. So, in listening to your podcast, I knew you were going to ask that question, and I had to call my parents and ask them how that worked out. And, my mom was a really good baker, and she later on, like years after this, started a bakery that did really well that funded my dad buying real estate. But, at every holiday, me and my brothers and my sister would bake with her. And, so we learned how to do that really well when we were young. And we lived across the street from a junior college. And at one point, there was a ton of construction crew repaving the whole parking lot. And, they wanted to get it done fast. So they had a ton of people out there. And so we decided to cook up a bunch of baked goods, brownies and chocolate chip cookies and all that stuff, and then bring it out there with water and sell it to the whole construction crew. And we actually did pretty well, selling to all these people. We made quite a bit of money for, as a young kid, quite a bit of money. And
awesome.
The funny thing is you have no break even. Your parents fund all the ingredients or whatever. But I think the funnier part of this story is, they said that I had that money for a little while, and somehow I knew what a bond was at that young age. I was like 9 or 10. I think the only thing that we could come up with is that my grandpa was also an entrepreneur. He owned a bunch of real estate and had a couple companies, and, he owned a bunch of bonds. So we figured I probably learned it from him. And my mom took me into the Bank of America in Saratoga because I wanted to buy the bond. And I asked the teller, I was like, I want to buy a bond. And she's like, well, you're about $900 short for that bond. And she's like, you don't want to buy that anyways because, it's kind of a boring investment. And I think it's funny now, knowing what I know about the financial markets, that was like 9 or 10 years into a 40-year bull market in bonds. But right around that same time, a couple years later, I started painting rentals with my dad. And actually, my grandpa had been developing apartments and some medical office at that time. And he told me real estate's the best investment you can make. And then my dad, a few years later, he was developing single family and he had some rentals, and he told me the same thing. And so I kind of knew that's what I wanted to go into. And I came out of college right into mortgages, and I had a couple good years, and then 2008 hit. And those two experiences, my family telling me that real estate's the best investment you can make, and then coming out right into 2008, like so many others, it influenced a lot of the things that I do now with risk and reward and how I underwrite. I do it a little bit different, which would probably be one of the more valuable things for your listeners later on in the podcast.
Awesome. Well, mate, that's an incredible story. And clearly I think you mentioned your uncle rubbed off on you at an early age to want you to go into bonds. But as a 9-year-old, I don't think I knew what a bond was at 9 years of age. So, just buying a bicycle or a skateboard was probably what I'm saving up for. But that's awesome, mate. Really, really incredible story. So walk us through the path into real estate. You mentioned that you've had a varying array of backgrounds and experiences in the different real estate sectors, but did you just naturally fall into it, or what was the impetus to get involved in it, or was it from your parents telling you always got to get involved in real estate?
Yeah, so it was my, actually going back to my great grandpa. He bought his first piece of land in 1906 in the Bay Area, and everybody's kind of had this a little bit of a real estate background. They're all entrepreneurs, not in real estate. I mean, like my family owns a winery, which has a really long backstory going back to the, Prohibition and Depression. But, they all had real estate, and my grandpa and my dad telling me that early, I knew exactly what I wanted to do coming out of college, and I went into mortgages, but I didn't know what I was looking at now, and maybe a lot of other people didn't know back then either. But these option arms and like 2-year fixed loans with 3-year prepays. I actually left the mortgage industry a little bit before 2007, so I left early, and I went and actually bartended, and I thought it was the worst decision of my life, but. And, the first part of my career kind of was like a roller coaster in real estate, which served me later. But, looking back on it now, I can't remember where I found the term, but I call it JOMO, like joy of missing out, because I left the mortgage industry and I was bartending, and I actually met my senior in commercial real estate while I was bartending. He came into the bar. He actually had met my girlfriend, which was his neighbor, and he then ended up hiring me, and I sold single tenant net lease and office industrial. And when I was in the commercial space, it was probably because it was after 2008, but at a certain point I looked around, and not many people own real estate in my office, and I knew I always wanted to own. And I was like, maybe this isn't the right spot for me. And so I actually left and then went into, buying distressed debt in private equity in these large pools, which was a really fun part of my career. The owner of that company was a great mentor. He kind of there's always the way to make a deal. There's always a price for it and always a structure to make deals. And I learned a ton from him, but as I said, it was kind of a roller coaster. That company ended up changing directions, firing, 95% of their staff. And, the next thing that I did was go into work for a residential developer and fix and flip company. And that's when everything kind of came together and gelled. And, all these different avenues that I'd worked in the past. I even did some leasing back then as well. But all these different areas of real estate that I worked in started to gel, and all these different ways to put deals together kind of gelled. And I ended up breaking all the sales records for that company. And then, the growth kind of stagnated a bit. And that's when I jumped out and started my own company. And, there's, as with any business, there was a roller coaster ride in there. I had a partner for a while, and he didn't ended up panning out. He did some things that probably weren't the best for the company. But going through the roller coaster early in my career makes you super resourceful. And so when I split with that partner, I had to fire all the contractors off all the jobs that we had, and take them all over and finish them out. And some of these things that I was talking about that I learned in 2008 and after, and the way I purchased, was what protected me. And I actually was able to come out of that with no investors losing money, even though he's doing some really shady stuff. And, then it was easy once I protected all of them, and I was super open with them. I wanted them to trust me as investors. So I told them everything that was going on, like some of the construction, overpayments and not knowing where the money was going, all that type of stuff. And so once I came out of it, they were all like, well, you just protected us through something like that, which is huge. We all want to go bigger. So it allowed me to, kind of catapult my business to where I am now, like tenfold better, with better asset managers and project managers and, team of operations and all that. That's what allowed me to then go to this fund structure that we're going to.
That's awesome. It's such a varying array of experiences, which I think is really important for the listeners to understand, because there's not just one path to starting a business. Right? You look relatively young. You don't have grey hair. You've been around the street a few times, been around the block a few times because you had to, right? You had to just had to put food on the table. You had to keep a roof over your head. And for every time you've had to transition jobs through probably no fault of your own, you're saying that, the mortgage company changed directions. You always had to keep moving forward and keep picking up skill sets. And I think that's really, really important for those people listening out there when you're getting started in real estate to not poo-poo different opportunities to learn. And I think that's an incredible accolade to you, because now you're at a point where you have the confidence, you've been through a couple of ups and downs to say, I'm going to run my business differently because I've been through some bad experiences. But one of the questions that comes up is, I mentioned San Diego earlier. How are you doing deals in San Diego in this market right now?
I mean, so this actually gets into, like when 2008 happened, that was a really traumatic time in real estate for a lot of people. And I heard somebody on one of your other podcasts talking about how you can't let fear drive you. If you're doing that, then it is a problem. It's going to limit your growth in what you do in business. And for a while, it actually did. So I became a voracious reader and studier of the markets. And it was a few years after 2008, I read Nassim Taleb, and I started experimenting with tail risk hedging, which is a thing in the options market. But you put these little tiny bets on, so it limits your profit a bit. But when something like COVID happens, it pays off multiple, 20x, 30x times your investment, and it can cover your losses. But in learning how to do the option stuff, you kind of meander to some of these other things like institutional macro, which is something that I use now in my business that protects me. And, I like to challenge some of the narratives within our real estate space. And, the narratives that I like to challenge are everybody you ever talk to always says, we buy value add assets in great locations, and, real estate's local. But it's these macro moves like 2008, COVID, even 2018, there was an interest rate spike that took out a lot of funds in my market. And those are all macro moves. And so I kind of think you need to trickle from macro down to the micro, and I can tell you why that's important if you want to get into that.
Let's get into it, because I think you bring up a very good point. So many people, including myself, I invest in Texas, right? I live in Los Angeles, and I also look at deals in other parts of the country. I'm not in that market, right? I don't buy my backyard. I'd love to buy in downtown Los Angeles, but it's just too expensive, right?
Yeah.
So I'd love you to give me your 2 cents on the macro dribbling down into the micro in terms of real estate is local, and why that is so important in your business when you're buying that, as you said, well-positioned assets that have a ton of value add.
Yeah, and this will lead back to your question of how I find the profitable deals in San Diego. So you start with the macro, and you want to know, are you in stagflation? Are you in real inflation? Are you in a Goldilocks, or are you going into deflation? And contrary, in studying this stuff, contrary to beliefs, everybody calls COVID a black swan. It actually, if you look at Nassim Taleb, who coined the term, he says it wasn't. And it's because he's a student of Mandelbrot, and the things like copper, the commodities, the dollar, gold, the treasury market, they were all signaling that this sell-off was going to come. You didn't know it was going to be COVID, but is all signaling that it was going to come. So you start with that, for right now, in the next few quarters, it's starting to become known, but we're going to go into stagflation. You hear the Fed talking about how it's transitory inflation and all this stuff, but then you look at their projections and there's no transitory part about it. Their inflation just keeps on going for the next few quarters. So once you know what,
so just to cut you off, what's the difference between, just for listeners, difference between stagflation and inflation? So you're stagnant in one high position of inflation. Is that correct? So
it's when you have inflation, but you're stagnating on like growth and like wages and like GDP and stuff like that. So it's kind of a funky market, and usually it doesn't.
It's inflation being high, but stagnant on your GDP and your wage growth. Is that correct?
Yeah, and growth, and usually it's a tougher market than currently. But the Fed is actually manipulating the treasury markets. I mean, they are kind of messing with the CFTCs and options, futures and options market on the treasuries, which I think is probably too technical for this conversation. But you just know that like when they limit that, they're the only people who can do that legally, and it manipulates the way the interest rates move. Mm-hmm. But anyway, so we're going into stagflation. The next level down, why I challenge people on the value add assets. If you look at some, Zell said this first about New York, and then I talked to a guy at an invite only fund conference who was a land kicker who sold to all the large developers, and he said that it was going on across the Pacific Northwest. But I'm going to talk about San Diego. Since 2008, there's been inflation in building supply, and a lot of the developers went out, and the ones that are left, they're seeing this inflation in building supply. They're like, how do I make my margins? So everybody built the top end of the market. If you look at their residential all the way up until COVID, until the Fed started buying the MBS market, the top markets like Rancho Santa Fe and San Diego is probably like the most affluent zip code in this market, and it had 13.2 months of inventory because people were building out there and nobody was buying. And then La Jolla and other areas like that, above 1 million there was 6 months of inventory, and below 1 million there was 1.8. So that's like an extreme buyer's market and an extreme seller's market. And then you can go over to something like the apartments, and you could see, like, say on CoStar Analytics that the top tier markets, there's like 6,200 deliveries, and then you go down the next tier, there's like 450, and then you go down to the next tier and there's like 14 at the bottom end of the market. So everybody's building into the top end of the market, and I'm like, that's why I say the value add part is like, if you're buying value add where everybody else is delivering their inventory, is it really value add? Are you getting it cheap enough to offset that supply that's the wave that's coming?
Right. And I just want to jump in there because it's a very interesting point you bring up because of how frothy I'm seeing, like just in markets I know other investors are in, like Phoenix, for example, 1970s assets going for over 200K a door, right?
Yes.
And that to me just is nuts, right? I mean, I know, and this is for my listeners, I know that if I buy something at 200K a door, I need to get a 50% growth on that value to make a 15% IRR to my investors, which means I need to sell it for 300K a door in 3 to 5 years' time. Do I believe I can do that? Now, the rule of thumb has always been 250K a door, give or take, for a wrap style product, depending on your market, right? Maybe a little bit less for garden style, maybe like 170 to 200 if you've got all land all in. In coastal markets, it's obviously a little different, but I'm talking about interiors. So it's very interesting you bring that, because I'm struggling with the exact same thing, and a lot of people are when they're penciling deals in today's market, where these obsolescent assets are now trading for just shy of what it takes to replace them, right? So, like, you're not going to scrape the dirt and then build again, right? You have to keep going. Like, people still need a roof over their head. So it's super interesting.
Yeah, and so then the next tier down is like, so at first I think I should say that, like, I didn't have this all dialed from the start. A lot of you kind of like fire yourself from jobs as you grow your business, and you might be researching the entitlement, you might be researching the market at the start. Now I have quants that map the market for me. I have people who are really professional in entitlement. They've been doing it for like 40 years. They kind of keep me ahead of the curve. And so once you see that everybody's like 93% of the market is building rentals into the high end, you're like, how can I create inventory at the low end where nobody's building? And that's where you're going to see the highest growth, because there's no inventory. Mm-hmm. And you also hear things like Biden talking about how they're going to incentivize first-time home buyers now, and they're incentivizing into no inventory. Or, the housing affordability crisis, that's on the low end. That's not on the high end with the price agnostic buyers. And so you have to then go to, like zoning and entitlement, what's going on there. Like San Diego's led the way in for California in, making it easier to build ADUs. But I always think that,
and ADUs just for the sorry to cut you off.
It's okay.
Accessible dwelling units are for those people who just a granny flat in the back of your house. So you have extra land you can build on. But keep going.
Yeah, and so they're exactly, and they're leading the way on making that easier. But I always think you have to like go one step above like what everybody's doing, and you have to get into it. Go to lunch with your guy who does entitlements and find the things that nobody are looking at with parking or whatever, that are going to make it easier for you to actually easier, cheaper, and faster to get through like the city, to then create your margin if you're going to build into that low end with these high, building costs. Or even like, something that I've done recently is, a lot of mom and pop retailers are hurting, and these little buildings in San Diego are really easy to entitle if you change them over. And because they're hurting, they're fire saling it low enough that you can actually change the use. And so, like ADUs, change of use, and then, within within the residential side on the fix and flip stuff that I do, I'm not sure this is very nice to say, but most, like the top, like 5% of the agents make, 90% of the money, or whatever the statistic is. Yep. And the rest of them maybe aren't necessarily as good at pricing and putting the correct information into their listing. And if you do a little extra work, you can find these deals that, people price wrong. And that actually goes back to the options thing. When you're trading options, you're looking for price inefficiencies using math. And the guys that I follow use something called fractals, but again, that's probably above what we're talking about. The point is that they look for price inefficiencies, and that's what you're kind of doing in the market. Since that everybody's building the top end, most people that claim they do macro are just like listening to the Fed or something. You need these processes and systems in place to actually go find these price inefficiencies in the market to then outperform. And as you asked, like now that I laid it out there, that's kind of how I've still been able to operate within the San Diego market. And I kind of, having multiple acquisition strategies is beneficial depending on where you are at macro and where you are as you trickle down from, micro at the whole market level to micro in, say La Jolla or City Heights or whatever. And that's kind of my process.
No, that's it's great. And you bring up some good information and tidbits there, but I want to challenge you. What's the, building on mass, right? And you mentioned earlier stagflation. The biggest thing that I think I'm getting into it. Inflation is going up, cost of construction is going up, but wages are staying stagnant. So people are not getting paid enough. How are they going to go afford the new homes, right? And that's where the renting comes in, right? They still need to rent. Well, rent's going up, right? Well, if their wages ain't keeping up, how's the rent? How are they going to afford the rent? So it's very cyclical. So I want to challenge you. If you've got high cost of building, wages aren't going anywhere or very stagnant, but yet everything's costing more, then what's the solution here?
So,
let's solve all the world problems today.
I don't think this is necessarily accessible to most, but the easiest thing to do in that situation is buy notes. And we haven't seen, because the government's allowing the banks to hold a lot of these distressed notes off balance sheet and kind of recreate extend and pretend that we did in 2008 with like FDIC loss share and TARP and things like that. We haven't seen that wave. That's actually the best thing to go after if that distress wave ever actually comes. I think they'll just keep pushing it like 2008 for 5 years until the values come back. But you're still going to get inflation on the asset, especially with them holding rates so low and manipulating kind of the treasury markets, not putting out as many. So at auction, they kind of still get bid up on the bond price, and the rate stays low. But you're exactly right. And this goes into the K-shaped dynamic of the recovery. They're showing income growth, but they're also, it's because the bottom earners fell out. Now they're returning, and so the wages are going to come back down. And so you kind of have to buy the assets, do the value add, and wait for the inflation to catch into true inflation, which will happen later on down the road.
When do you think?
If you want to get into it, there's something called base effects and rate of change. And base effects and rate of change are almost like comping property. And so we're going to kind of stagflate till second quarter of next year. But, just like comping property, second quarter of next year, we're going to be comping against this second quarter, which was the highest blowout numbers that we've ever seen in history because we printed so much money. So we're going to get kind of like a deflationary piece in that, and that's when we'll take hold into true inflation after the deflationary move. And so, in looking at these things, you can kind of see where to sit now, and then when to start selling a few of your assets to build up cash, and then when to buy again. But as far as what you're saying about the wages, so right now we're already seeing some inflation in the rents. You know what I mean? And whether people can,
ridiculous. I'll just jump in here and say, on my portfolio, I'm literally doing nothing, turning the unit and getting $300. Where rewind a year ago, I'm getting in some of my San Antonio properties, like putting in $7,500, putting in into a unit, and this is on 150 and squeezing maybe 125. And all of a sudden, a year later, 2 years later, it's just like I blink and it goes up in rent. And I'm like, what is going on?
So it's these inflation numbers, like we were sitting at like 2% inflation this whole cycle. And then now the numbers that are coming out are like 4.5 to 5.5 for inflation. That's a huge difference. Plus massive. we're getting people returning to work so they can actually pay those, because now they're taking, 20, I think if I remember correctly, like 26 states gave back the money that was they're giving the extra unemployment. So that's forcing everybody back to work. So we'll get the wages back by people actually going back to work. Their growth is just going to make it tougher for those people to actually pay rent, because you'll still get the rent inflation, but they're still going to kind of make the same amount. So there'll be a cap that will hit. But I should say, the eviction moratorium has kind of held down how much the rents can actually go up, because people can't move those people out that aren't paying and then release them up at a higher rate. So even the Fed now, if you don't listen to what they say, if you actually read their reports, are talking about double the amount of increase over the next year in rents once the eviction moratorium lifts, which will have, like, one of the biggest pieces of the inflation number is housing and rentals, which will have a even greater effect. Like I was saying earlier in our conversation, it's not transitory, and these are the reasons. Like, as the eviction moratorium lifts, we get this rent growth, we're going to get more inflation, because that's a huge part of the inflation number. Whether, and that's kind of something that you have to watch with this macro data, is like when down to the micro too, like when on the macro level, is it going to cap out on these low end people being able to pay a higher rent? And then also within your submarket, what's the income of your submarket, and when's that going to cap out and you're going to have some more like vacancies? But yeah.
So now let's talk about you're raising a fund, right?
Yeah.
And how you're going about raising a fund, and how much are you trying to raise right now?
We're trying to raise 50 million, and it's kind of exciting because, I got some of the, from doing this and having like good returns and things, like I've become kind of known in my submarket. And so like a bunch of people, once I was doing this, some of the best people in Southern California are like, oh, we want to jump on board and let's do this. And so I'm going to give them some equity. And there's, some more interesting things that you can do with like controlling risk within a fund. And if you listen to like, Michael Milken or, Howard Marks or, Carl Icahn, they talk about how like the, length of term of your fund and how it can protect you, or how you use debt within the fund, how that can protect you. And, a lot of this macro stuff that we're talking about can then, like as you're buying an asset, you go from the micro and you trickle up. And as you're doing portfolio management, you go from the macro and trickle down to the submarkets, to which assets you want to like keep and sell off, and depending on where you are in the market. So, one of the most fun things I think in real estate is being able to be creative and kind of learn and like grow. And, this is my next stage of growth, and how I can be a little bit more creative in how I use debt and capital to go a little bit bigger and have a, not only are these people really good at what they do that are coming on board, they're actually really cool people as well that I think would be fun to work with. And that's awesome. Something that your previous guest, Jason Trudeau, he's my COO, and he always talks about that, like building the team from the ground up to be strong.
Yeah, no, I completely agree. What's with the fund? Are you raising that from institutions, or are you raising that from private investors, or a little bit of both?
A little bit of both. I don't think like this is something that I did when I first started raising. I think I was like, oh, you got to have 50 million and just like jump in. But no, you kind of like, raise like 5 and start turning it. And then you jump up, from like maybe accredited friends and family to accredited, mm-hmm. within the GP. And then you jump up to maybe like the institutional guys in the LP once you have, quite a few assets that are performing well. So it'll probably be like progressions, and I think that's a good lesson anytime in business, like don't build it up too big in your head. Like take those small steps of like doing one deal and then doing 3 and then doing 10, type of thing.
I love that. No, I completely agree with that. I remember my first deal, it was only a small triplex, and I talk about this a lot on different podcasts that I get interviewed on. This was nearly 10 years ago. And you don't get to deal number 10 without doing deal number 1. And if you want to go raise a fund, like I'm even thinking about raising a fund, right? And I'd love to talk to you offline about what you're doing and how you go about doing it. But it's like, oh God, I want to raise $50 million. Where do I start? Do I just go just start going advertising? But it's to your point, you got to go raise 5, and then you raise another 7 on top of that, and you raise another 10, and it's slowly building on top of that, and that money's going to work as you're rolling it out. So and
you even have like a 2-year raise period, and then like a 5-year deployment period and roll up. And during that 2 years, you're going to be deploying and then pulling in more, and then deploying and pulling in more. And there's subscription loans and things that you can do once you have the committed capital before you pull it into, see the money's ready immediately to buy the deal, and then you pull in the subscription. There's a lot of interesting things that you can do within a fund.
That's awesome. Mate. Look, as we come to the end of every show, I like to ask you to dive into the top 5 investing tips. You ready to get into it?
Sure.
Mate, what is the number 1 habit you practice to keep on track towards your goals?
I'd say, if you listen to Richard Branson, he's like, how do you be more productive? And he said, work out. And I think that's a huge one for mindset and everything. It makes you more productive over the day. Reading and time blocking are a couple others. And then, obviously like building systems within your company is a huge one. So you can free up your time, and, taking breaks is important. Once you have the systems in place, taking breaks so you actually can re-up your energy of your mind to go after this stuff is important as well.
100%. Completely agree. Question number 2 is, who's the most influential person in your career?
So there's so many. As far as like people I don't know and like books that I've read, it's probably Sam Zell and Nassim Taleb. People that I'm closer to that kind of influence this macro stuff. There's a team at Hedgeye that's really amazing. Keith McCullough and Josh Steiner are they know this stuff far superior to what I'm telling you here on this podcast, and they influence a lot of my investment decisions as well. But the most influential as of recent time was your previous podcast guest that I'm closest to, which is Jason True. And, he's kind of like the CEO whisperer. He either deals with startups or he deals with, like $1 billion companies fixing their teams and things. And, from like psychology to, how to build a good team, everything. He's kind of like catapulted me to the next level.
That's awesome. I remember Jason being on the show. It was actually about a good year and a half ago now. So it's interesting. It's a small world once you start talking to people in this industry. So it's awesome stuff. Question number 3 is, what's the most influential tool in your business? And when I say tool, it could be a physical tool like a journal, or it could be a piece of software that you can't run the business without. What is it?
I would say it's those quants at Hedgeye. And you're not going to start there. Like I said, you got
to learn about it.
You got to learn about it first, and then kind of jump up levels. And I'm kind of blessed now to be able to have them be part of my team.
That's awesome. Question number 4, in one sentence, what has been the biggest failure or mistake that you made in your career, and what did you learn from that failure or mistake?
Partnering with the wrong person, and kind of having that. And he was a friend too, so I probably let it go on a little longer than I should have, because I knew him for like 10 years prior. But once you get out of that, it kind of catapults your growth as well, and like you learn like what values to look for in a partner or in employees. And I think, team building and who you got on the bus, as they say in Good to Great, is like the most important thing you can have in your business. It can either make you crazy happy and successful, or it can make you in the living hell.
Exactly.
Yeah.
I couldn't agree more that your team is so important when you surround yourself with. And I like what you said earlier, and I'll mention this in the end, but how you go about doing things in your business, but you know it's like a job, but then you fire yourself from that because you're starting to grow, and you bring people in to do the asset management or the underwriting or whatever it might be. So yeah, bloody love it, mate. Question number 5 is, where can people reach you to continue the conversation? They want to be in your sphere. Where do they go?
I'm not that much on social media, but you can find me on LinkedIn, Vince Caviglia, as well as equitygroupinvestors.com is another place. And that's probably the 2 spots to reach out.
Awesome, man. Well, look, I want to thank you so much for jumping on today's show. Some things I took away from today, I think, was just your really deep knowledge about talking about a stagnation, not inflation, and where we're going. I also think how you've used your ability to have different jobs or careers as but always keep picking up information and sharpening your tools as you went through that transition in your early career, which has helped you put you on the right path today with your business. And that's so important for so many people out there. I mentioned that earlier in the show, that don't think of a job as a bore. Think of it as something you can learn a skill through. And you've done exactly that. And you've now applied this in so many different ways, that you look at markets, the way you look at deals, how you look at valuation, how you look at inflation versus deflation versus, Goldilocks versus, all the things that we've been talking about. And it puts you in a really good position because of that very well-versed background and array of experiences to be a really good business leader and to go out and find opportunities. And I think the last thing I took away is surrounding yourself with people that you may not be able to do it, like you're starting your fund. So bring on the right people who know how to do it so you can be successful. Don't think you can do it all by yourself. I think that's super important. So to leave anything out?
No, I think you nailed it there. And, just to add to that, doing well isn't normally when you learn the most. Right. And yes. Also too, this is something that Jason told me too, is as you go through your career, these ups and downs, all you want to do with your new skill set is shorten them. From going on up and down in the earlier part of my career, once I split with that partner and had a really rough time, I shortened that window, compressed it a lot. And I think those hard times are what you learn most from.
100%.
Yeah,
man. Look, buddy, thank you so much for jumping on the show. Enjoy San Diego, and we will catch up very, very soon.
Thank you so much.
Well, there you have another cracking episode, Jam, with some incredible advice from Vince. Remember, if you do want to check him out, head over to LinkedIn and type in his name. It's Vince Caviglia. So it's spelled with a G, but it's silent. Caviglia. So Vince Caviglia. And check out what he's doing. He's doing some incredible stuff. He's really knowledgeable about all the different market types and how that affects both macro and microeconomics in certain locations around the United States. Wealth of knowledge. Really implore you guys to reach out to him if you want to be in his circle a little bit more. I want to thank you all again for taking some time out of your day to tune in to continue to grow your financial IQ, because that's what we're all about here on this show. And remember, if you do want to jump on the newsletter and find out all about our latest investments, head over to reedgoosens.com and join the newsletter. Jump on a scheduled call with me. And if you do like this show, the easiest way to give back is to give it a 5-star review on iTunes. And we're going to do it all again next week. So remember, be bold, be brave, and go give life a crack.